Well, hello, and thank you for joining us today. It's my great pleasure to be introducing you to Vinva Investment Management. In August this year, as part of our commitment to delivering investment excellence to our clients, Magellan formed a strategic partnership with Vinva Investment Management. This partnership involved Magellan taking a strategic stake in Vinva Holdings Limited, the parent company of Vinva, which includes a global distribution arrangement. This enables us at Magellan to distribute Vinva's systematic equity strategies to our clients around the world, excluding the domestic institutional market where they already have a well-established presence. Vinva, established back in 2010, is an independent, predominantly employee-owned global investment management firm based here in Sydney, who is a pioneer in systematic equity strategies and specialises in long-only and long-short investing across Australian and global equity markets. I'm joined here today by two lead portfolio managers from Vinva, Steve Malin and Trent Larkham. Both Steve and Trent joined Vinva in 2012 as portfolio managers, focusing on the allocation of capital across different strategies whilst optimising for factors such as diversification, liquidity and transaction costs. Welcome, Steve. Welcome, Trent. Finally, before I begin, please see the disclaimer on your screen. I'll also remind you that if you would like to submit a question to Steve or Trent during this webinar, please do so by typing in the question box on screen. This will come directly through to me, and any questions that we don't get through today, we will respond to after the webinar. Okay, let's kick off. I might start with you, Trent. For those of you who are unfamiliar with Vinva, can you give us a brief overview about Vinva and the team?
Thanks, Mark. It's great to be here, and we're looking forward to presenting Vinva to your viewers and listeners out there. As you said, Mark, 2010 was when Vinva was founded and launched its first fund. But the genesis of Vinva dates back to the 1990s, where Maury Wakert and others worked together at Barclays Global Investors. So many of the team have been working together for over 2 decades. This might surprise some of you that we've been around for this long, as many might not have heard of Vinva. That's likely because we've primarily been focused on the institutional market, and only recently have we been interacting with the wholesale and retail market. Vinva is a specialist active equity manager with a single investment philosophy and approach. We're currently running long-only and long-short strategies in Australian and global equities, managing approximately $23 billion, with a proven long-term track record of delivering consistent outperformance over time. Vinva is a pioneer in systematic equity strategies, as Mark said, creating insight-driven ideas with state-of-the-art systems. We're considered market leaders in language processing, machine learning, and AI techniques. There are 26 people at Vinva, 14 investment professionals and 12 non-investment professionals who sit across client relationship, sales, ESG, compliance, compliance and tech infrastructure. The firm is set up to have minimal distractions so we can focus on those areas where we think we can add value in investment management, client relationships and risk management. Maury Wakert heads up the Vinva investment team. He was originally hired at BGI in 1997 to set up the Australian active equity business and went on to become the global CIO from here in Australia, looking after all of BGI's active systematic equities, managing over $300 billion. The Vinva investment team is one of the most stable and experienced teams in the market, providing clients with continuity and certainty.
Great. Thanks, Trent. You mentioned Vinva's investment style is described as systematic, and can you talk us through perhaps what this investment style means? Maybe Steve, you can take this one.
Sure. Thanks, Mark. So we like to describe ourselves as bottom-up systematic stock pickers, and everything really starts with our research process, where we develop this evolving suite of models, also known as signals, for forecasting outperformance of stocks. You can see that on the slide there, mentioned in the bottom left. Now, all the models and strategies that we use have to make fundamental sense to us, so we're not data mining ideas. In fact, all the 50+ strategies that we use have a very strong fundamental basis in common sense. And many are not that different to the approaches taken by lots of active managers. You know, we look at cash flows, we look at earning stability, we look at valuations, all of that sort of stuff. But it's how we use those ideas that's a bit different. And this is where the systematic part comes in. As sort of illustrated by the top two icons on the slide here, we deploy these strategies to continually monitor for changes in the data. And this is what drives our stock views. So whenever we rebalance our portfolios, we always have the latest view as to which stocks are candidates for inclusion in the portfolio and which should be removed. And last but not least, we overlay this with some very stringent risk controls. Little icon in the bottom right there. It's a very disciplined process, which takes a lot of the emotion out of investing, and it avoids many of those human biases that often plague investors and impact returns. And it results in a very consistent, style-neutral alpha generation process, which is insulated from those large macro shocks.
Thanks, Steve. Just continuing on the investment approach conversation, maybe one for you, Trent. What makes Vinva's investment approach unique?
Yeah, sure, Mark. I think the uniqueness in our investment approach is that we have a combination of a number of attributes. I think many of our peers have one, two, or a few of these attributes, but not all. I think that's what sets us apart. So consistency in alpha over long periods. I think if we look back since 1997, there's been over 285 rolling 3-year periods in which we've outperformed 82% of the time. And if you think the amount of shocks and different market environments we've had since 1997, it's a testament to the team of that consistency of alpha throughout all those periods. Experienced, stable team with continuous innovation. Our biggest asset are our people. The success of our investment strategies ultimately depend on the quality of our team and the investment insights allowing us to adapt to dynamic market conditions and continually innovating and staying ahead of the curve. Our proprietary dynamic portfolio construction and optimization process. This provides a distinct advantage and allows us to optimally combine our investment insights with varying time horizons, whilst considering the risks and costs associated with that. It's what we call a multi-period optimization process, whilst many of our peers focus on a single point in time. Another attribute is our alignment with our clients. Employee-owned business with one employee, with an employee sharing the same investment philosophy, creating a strong culture and alignment to our clients. Our business is accessible. I think many think that due to the fact that we're a systematic investment manager, that we're not accessible. That's far from the truth, and it's testament to Steve and I sitting here on this webinar today. And lastly, our market knowledge. I think again, some people might assume from a systematic perspective, we mightn't pride ourselves on having a deep understanding of the investment markets. That's far from the truth. A key component in identifying where market inefficiencies lie and exist is understanding your investment markets.
Thanks, Trent. One of the things that systematic equities often gets associated with is processing large amounts of data. Can you give us some insight into how you do that? Steve, maybe you want to tackle that one?
Happy to. Thanks, Mark. We've got a slide up here. So when we think about data, we're really thinking about any information that has the potential to drive share price change for a stock. So for example, news articles, sell-side reports, conference calls, earnings announcements, financial statements, governance metrics, macro data, all of that sort of stuff. And we're also thinking about how that same information impacts on related stocks within the same ecosystem. Because information which impacts the share prices of peers or competitors has the potential to have a knock-on impact. And that's where our company linkage analysis comes in. We're talking about 12 million linkages between companies. So we've got about 15,000 companies in our investment universe, and we're typically holding in excess of 600 positions in our portfolios. So we're talking about really vast amounts of information. And we really need a very robust technology platform to enable us to keep everything up to date. And this is where we as a firm invest a lot in terms of our resources and in our investment technology team who actually sit within the investment team itself. They're obviously extremely experienced in this area. Our software and our systems, they run 24 hours a day, 365 days a year, over 350 hours of processing every day. And this is what gives us what we believe is that information advantage over the average active manager. Just moving on to the next slide here, it's worth mentioning the fact that a lot of the information that we process is unstructured text. So we need a very effective way of quantifying this information. And this is something that we've been focused on for a long time through our natural language processing capabilities. You know, as an example, every analyst report that gets published by a broker gets consumed by our process within minutes. And we're extracting a whole range of information from these reports. You know, we're always listening out for things that have the potential to impact share prices. Changes in sentiment towards the stock, particular events, you know, forecasts around future growth, cash flows, comments around management, etc. All of that stuff. And that's really where our experience comes in. That's around knowing what to listen out for. And the nice thing is that about this technology that now developed, we can essentially apply it to a broad range of data sets. So for example, we can read millions of news articles, you know, listen to thousands of conference calls, so that when we come into the office in the morning, we've already got a great starting point for rebalancing our portfolios. This is obviously very handy, you know, especially when you think about what happens overnight in the US, which is a very big part of our universe. It's probably worth mentioning that Vinva has been a bit of a pioneer in this area in applying text processing to investment markets. Back in 2006, we were the first investment manager, to our knowledge, to use these sorts of tools. Now, obviously, things have evolved pretty dramatically and accelerated over recent years, and we fully expect that to continue. You know, for us, it's about continuing to be part of that technology journey and leveraging our experience and skills and continuing to invest in our technology and infrastructure as we move forward.
Great, thanks. Thanks, Steve. I just want to move to you've talked about the data and the processing of data. You've talked about your investment approach. Let's talk about portfolio construction. Can you talk through how you construct a portfolio, both of you?
Sure, Mark. So our portfolio construction process is proprietary. It's completely an integrated process where we take our stock ranking model, risk models, and transaction cost forecasts, and we combine them and put them into the dynamic optimization process. Firstly, our stock selection process, stock ranking model. This is driven by signals or what we call investment insights that are generated by our research process. Our signals cover a broad range of information sources across different time horizons, i.e. we're trying to capture outperformance and market inefficiencies across varying time horizons, 1 day up to 1 year. Secondly, our risk model, used to monitor portfolio tracking error and exposure to style factors, such things as size, leverage, and growth, etc. Our optimization process then places bounds on styles, countries, industry, and risk factors to ensure the portfolio remains within specified limits. What the risk model and optimization process does is essentially neutralize any unintended bets that the portfolio might be taking. Thirdly, we apply our T-cost forecast into the portfolio construction process. It's important that we take into account entry, exit T-costs. By taking into consideration our alphas or our stock forecast returns, our risk and our costs, it essentially allows us to create efficient portfolios which maximize the expected return after T-costs. It also ensures that we are only taking active positions that are intended and we are expected to be adequately compensated, i.e. the return is over the risk and costs.
Step in there. So taking a look at the output from this process, you can start to get a little bit of a flavour for how we look to insulate the portfolio from macro risks and produce that benchmark-aligned risk profile that we spoke about. So a helicopter view of the portfolio will show that we always have very tight exposures on things like countries, sectors, industries, currencies, styles, etc. As illustrated on this slide, we do take some risk here, but it's very modest and very controlled. These macro segments can easily be knocked around by macro shocks. For example, if you think about the energy sector, which has a lot of names which are highly dependent on the oil price, or the financial sector, which has a lot of companies tied to interest rates or political risks in any given country, being very underweight or overweight has the potential to dramatically impact portfolio returns if a big macro event occurs. And that's exactly what we're looking to avoid. We want to avoid exposing portfolios to any big shocks in any of these sorts of things. So where it gets a little bit more interesting from an alpha perspective is when we look inside those macro buckets. And again, we're trying to illustrate that on the slide here where we've drilled down into the materials sector. And on the right, we've got a schematic representation of positions that might exist in one of our portfolios. So you can see we've got a range of positions from overweights on the left through to underweights on the right. But in aggregate, when we combine all of our active weights, we've got a very modest exposure to the materials sector overall. So it's really about implementing our stock views through lots of small positions and looking to systematically harvest the alpha whilst being very careful of the risks.
Great, thanks, guys. You talked about specialists in global equities and Australian equities. Well, Magellan's just recently launched two Vinva funds, with one more imminent, covering both Australian and global equities. Can you just explain the difference between Vinva's long-only and alpha extension strategies? Maybe Steve, do you want to take that one?
Sure. So the main difference is that the alpha extension employs a little bit of shorting in the portfolio construction process. Now, sometimes people hear the word shorting, they get very nervous, or it sounds very risky. But we think it's a great way to add value to a portfolio, so long as it's done in a very risk-controlled way. The great thing about our signals is that they're designed not just to forecast outperformers, but also to forecast underperforming stocks. So in a long-only context, how do you exploit the fact that we really don't like a stock? Well, all you can really do is not hold that stock at all. And it's probably best illustrated if we think about an example. One that we've been looking at quite closely this year is Albemarle. It's a US-listed lithium stock, and it's one that we've had a very negative view on. Now, that's a very, very small stock in the benchmark. So all we can do by not holding that is have a 1 basis point underweight position in our long-only portfolio. Now, it's been a good call. It's one that we've got right, but it's only managed to generate half a basis point of alpha. If we flip across to the 1-20-20 and think about the implementation of that view there, what we were able to do is employ a little bit of shorting to take a pretty modest 40-50 basis point position underweight or short the stock. And that was able to translate into around about 20 basis points of alpha for that portfolio. So you can see the difference and how we're getting a kicker from just employing a very modest bit of shorting in the portfolio.
Yeah, and just for clarification, 1-20-20 is what you also refer as alpha extension.
Correct.
Right.
So thank you for the questions that are coming through online. There's the number coming through, and I'll get to as many as I can. There is a question around the easy one first. Copy the slides; they will be available afterwards. So yes, and you can mention that on the feedback. A couple of questions that have come through, and I'll try and summarise where I can. We've seen different themes. Drive markets over the last few years. We've seen things like Mag 7, AI. Interest rates, shift markets from growth to value, and et cetera. How does Vinva perform in those markets?
Yeah, that's a good question. I think Mag 7 is probably the topic which has come up most in our meetings with investors over the last year. And it's clearly a topic that's on a lot of people's minds. But the nice thing for us, it's been a bit of a non-event, really. So our active stock bounds of roughly plus or minus 1%, we'll always ensure that we're relatively neutral on the big stocks. For example, if Apple is, say, 5% of the benchmark, we're going to be holding between 4 and 6% of Apple in our portfolio. So as a result, we haven't necessarily made a huge amount of alpha in those mega cap stocks, but we also haven't lost money. And what we've been able to do is to spend our risk budget elsewhere. We typically find that if we move down the cap spectrum a little bit, or we move into international markets away from those very, very well-researched, very well-covered names, that's where the opportunities sometimes sit. So staying neutral on the Mag 7 has meant it's been largely irrelevant. You mentioned, style, and that's an important one, particularly when we think about maybe 2022 versus 2023. 2022 was a big style year for value, and 2023 was a big style year for growth. And you have really mirror images in markets, if you look at returns of styles and signals. And what we were able to do, because we neutralize against those things, is to just keep chugging along, keep collecting our stock level alpha and generate some quite consistent returns through both of those periods. And that's really evidence of really everything that we've been talking about today about insulating the portfolio from macro whilst focusing on which is the better stock A or stock B and generating the outperformance that way.
Yeah, great. Thank you. Thanks for that, Steve. There's a couple of really good questions coming through. Maybe for you, Steve, around human intervention, and also, and I'll read this: data is not information. Information is not knowledge. Knowledge is not understanding. Understanding is not wisdom. The process appears to be very much data-driven. Where does the wisdom come into? So, combining maybe that human intervention and the wisdom. Steve, do you want to tackle that one? Or Trent, rather. Why don't you tackle that, Trent?
No, that's right. That's right. Yeah, so I suppose a lot of the efforts in human intervention, around our investment insights and our portfolio construction process and optimization process that we talked about, that's really the investment and efforts are put into. So, innovation within that area. And many questions come about as in when you produce your optimal portfolio trade list out of that process. Are you agnostic to what you're buying and selling? Well, we are agnostic to what we're buying and selling because all the work we put into that process is done. Our efforts are to improve that part of the process. Where there might be some intervention is in some unique market environments or stock-specific news where we think our models haven't factored in that particular piece of information or that particular environment. So we're very systematic in the way we approach that. We might make some adjustments and fine-tuning to some of the signals, etc., or adjust some risk profiles of some single stocks, etc. So that's about as much human intervention as we do with regards to the process.
Yeah. Just to add to that, the comment around where the knowledge is. So the knowledge is really upfront in us thinking about what drives stock returns and spending a lot of time researching what we believe is the correct suite of models and signals to help us pick stocks. What we want to avoid is coming in the morning and the models are suggesting we buy stock, but suddenly we let our human bias intervene and interrupt and say, okay, we don't like our stock for whatever reason it may be. That's where we think our process adds a lot of discipline. And in actual fact, a lot of investors fall into behavioral traps because they get sort of carried away by what's happening in terms of news flow or sentiment. By being very rigorous in how we decide what to buy or sell, we can alleviate a lot of that bias.
Yeah, great. Actually, there's a few questions coming through just on, you mentioned signals and a couple of people have referenced them as systematic flags. Can you maybe talk about a couple of signals that you apply or look for?
Yeah, look, I alluded earlier on that a lot of the information that we use is not that different to what you would hear a typical fundamental asset management firm think about. If we look for companies that are generating solid cash flows, we look to identify earnings certainty, some strong profitability numbers. Those sorts of things would feed into our management and quality signals. We also have a valuation component, which is pretty important to our process. We're agnostic about the sorts of valuation metrics that we apply, but we don't go in and buy a stock without considering how much it costs. We're not a style manager, as we've mentioned. We don't want to be exposed to value or growth in the portfolio, but that doesn't mean that we don't take into account how much a stock costs when we look to buy it. So, a lot of relative valuation metrics. And then we get into some of the more esoteric stuff. Obviously, the text processing, picking up some of that sentiment around news flows. We get a lot of voicemails and voice calls from analysts, which can be a handy way to pick up any catalysts that are coming up for a company and make sure that we're factoring in those to our portfolio.
And then additional to that is some of our global linkage signals. That's really utilising our ability to process large data and sort of processing power where we will try and link domestic stocks or stocks in the US to other global peers or any relevant piece of information or news items that we think can relate back to that stock and have relevance. So that's processing a lot of data, a lot of news items, a lot of reports. But the big thing there is linking them back to relevant stocks in the local market that's referring to. So that's part of our global linkage suite of signals.
Yeah, and the really nice thing about those linkage signals is that they make such good common sense. If you're thinking about a stock which perhaps doesn't have any local peers in the market, but is very globally oriented, anybody who's looking to invest in that stock is likely to spend time thinking about its overseas peers or industry dynamics. We're doing exactly the same thing, but we're just doing it on a very, very large scale. And we're creating millions of these linkage metrics that we're applying these, what we call impulses through.
Great, thank you guys. A few more questions have come through around sort of forward-looking data, talking about the election, Trump. Maybe a question, Trent. How's that recent, the election? How's the portfolio performed? How do you think about those sorts of questions and those sorts of these sorts of changes that may not have been forecast?
Yeah, it's a good question, Mark. And thanks for the questions out there. It's been interesting with the election looming last week, and also the China stimulus talk. So plenty of big sort of thematics going on out there. I think we touched on a little bit about our investment process, how we're not taking a lot of big macro thematic bets within the portfolio, and we're aware of those. So the risk model, the optimization process sort of squashes and neutralizes a lot of those thematic bets. But in saying that, we do look at through the portfolios, and that's just from a portfolio management perspective to make sure we're aware of how the portfolio is positioned, going into an election. There's been a lot of talk about the Trump trade that was on, etc. The trade around sort of China stimulus, how we're exposed to a rate environment, a hiking environment, or a cut with regards to the rate cycle. So those different sort of thematics we do look at, but that's purely from an observational perspective. We don't constrain the portfolio, but we tend to find when we do analyse the portfolio with regards to some of these themes that we're not taking large bets within these themes, and that's just a function of how we construct the portfolios and the risk model that we apply over the portfolio, which, as I said at the start, tends to neutralise a lot of those sort of themes throughout the portfolio.
Just on that as well, if we're thinking about the election in particular and post-policy outcomes, things like onshoring, things like tariffs, we've been spending a fair bit of time trying to classify which stocks are likely to be most impacted. Not necessarily that we want to make a change to the portfolio, but just that we're aware of what the exposures are and keeping them modest. We can look to intervene if we see an exposure that's getting too large, but having 600 positions in the portfolio across such a large range of industries, sectors and countries means that the necessity for us to do that is relatively infrequent.
Yeah, they tend to play out with regards to, if you look at the global funds, how we constrain our country bets or sector bets. They're fairly tight, and that's sort of how it sort of plays out on the themes with regards to when we do look at those. So, but yeah, the last week I think you touched on the performance side of it, Mark. It's been a good week for us, sort of running into the election and sort of post the election, when I think we saw not necessarily large beta movements. We certainly saw it on the first day after the election, but certainly seen a lot of large sort of volatility in single stock price movements, particularly in the US, and that sort of pushed through throughout the other regions. And we've been really sort of pleased and happy sort of heading into that. Election's been talked about a lot, and then sort of post the election as well with regards to how the portfolio has stood up and performed well.
Fantastic. And maybe just the last question, just conscious of time. A couple of questions, sorry, I should say. You just kind of touched on it. No sectors you avoid. There was a question around crypto, but as it pertains to listed GIC sectors, are there any you particularly avoid?
No, we tailor certain signals for certain sectors, but there isn't any sector that we exclude completely from the process. There are some that we find are a little bit more fruitful for alpha exploitation. We weight a little bit more to those as far as risk spend, and that goes for countries and markets in certain segments. I mentioned US large caps before as an area where we tend to reduce the amount of risk spend there. Not that we're taking a large cap underweight in the portfolio. It's just around being neutral and spending the risk where we think we can extract most value.
Great. Well, thank you, guys. I'm just conscious of time. I might call a hold to the questions there. Thank you for those questions that have come through. I do want to say thanks to you, Steve and Trent, for your time and insights today. Hopefully that's given the audience a good introduction into Vinva and the process, the portfolio construction, and how you think about the portfolio and your approach to systematic investing. And also thanks to you in the audience for taking the time to join us today and your questions to both Trent and Steve. As a reminder, today's webinar will be available on our website, so please feel free to share with clients or colleagues. And finally, if you would like more information or would like to speak to us further about Vinva, please reach out directly to your Magellan representative or let us know via the contact form on the screen, and we will be in touch. Thank you and have a great day.
Thank you.